welcome to the Masterclass. It's 1:30, so it's time for class. My name is Daryl. I'm in here for Yalbanafo to continue our insightful weekly discussions, things that would benefit you as a business person or as an individual. And over the last 3 weeks, we've had great conversations with Yao Latte, who is partner at Deloitte Ghana. He's been talking about building a credible business plan. The week before last, we continued on the same line of conversation, talked about financing options for SMEs. First, we looked at the challenges finding financing. Then he went on to talk about actual sources. Some of the challenges he enumerated were high interest rates, insufficient collateral, not enough business angels. Sources, he mentioned examples such as microfinance institutions, government schemes, government guarantees, banks, crowdfunding. Last week, we talked about tax compliance issues for SMEs. In that conversation, we were privileged to have Gilbert Irenchi Ado, also of Deloitte Ghana, talk to us about tax obligations and the best way to oblige them. He distinguished between direct tax and indirect tax and explained other concepts in taxation. One strong point he made with us was that if you want to be successful in your business, then you must pay attention to your taxes. Pay attention to your taxes and get professional help. The same way insurance has brokers, tax management also has advisors who can hold your hand through the process. Well, today we are dealing with a new topic, and I'm excited about that because we have in studio Dennis, who is a senior manager in the Financial Advisory Business Unit in Deloitte. He has over 12 years experience working with 3 out of the big 4 accounting firms in Ghana. He is involved in the provision of a range of investment advisory services, mainly to corporate investors, lenders, and investee companies. These include financial due diligence reviews, business plan preparation, feasibility studies, and the value for money reviews, business valuations, financial modeling, and deal structuring and negotiation support. What don't you do, Dennis? You have a long list of what you do. But Dennis Brown, Financial Advisory, Deloitte Ghana, great to have you in studio. We are here to talk about what lenders and investors want to know. So grateful to have you in studio with us, Dennis Brown. Also, Institute of Chartered Accountants Ghana, a member of the Chartered Institute of Taxation. Hope you're having a great day so far.
Yeah, it's been okay.
It's been okay. You sound a bit modest about it, but you're welcome to the masterclass. As I've said, we've had insightful discussions with our guests from Deloitte the whole of this month, and so I'm looking forward to this conversation about what lenders and investors want to know. And just remind you that you can join us on Facebook because we are streaming live. So that you can have the audio-visual experience. And so I'm going to just head straight into the conversation with you, Dennis. So we've talked about building a business plan and all of that. How does a company build a good credit history?
Well, basically by ensuring that in their loan relationships, they do not go for more than what they can absorb. That then gives you opportunity to repay the loan as scheduled. And over time, if you've been in a number of loan relationships, then you would have charted a good history about it. In our system and in many other systems, credit bureaus collect information on, credit, those that have accessed credits, and they are able to, put out a report on what your credit history has been, and it goes to the heart of your credibility. So it's important that at key stages of your business, when you want to access funding, you access funding that you can pay, and then you take then you grow organically into it over time. With your credit history, with the credibility that you have built over time, you'll be able to access higher levels of funding, because then you are growing along the line, and that's one key thing investors want to see.
All right, and that's just one of several questions I'm sure will pop up during this time that you make your presentation. So I'm giving it to you to start with your presentation. Where do we start from?
Okay, as you indicated, we are here today to discuss what investors and lenders want to know, and in this case want to know about your business. Okay, and what we then mean is that what are the key things they consider before they invest in your business. Okay, our target today mainly are SMEs, but a lot of the things we'll discuss here today will apply to other businesses as well. And before we do that, let's try and set the context so that we can tailor the discussions to the benefit of our viewers and listeners. So I would like to revisit what probably you may have discussed with Yao the other day in terms of what the funding options are for SMEs. And as you indicated, I think that has been discussed already, so I'm just going to touch on them briefly without even explaining, because that has been properly flogged in previous sessions. So we are talking about microfinance institutions. These type of institutions specializes in providing funding for SMEs. They are regarded as institutions that have built the competencies to understand the risk and opportunities in the SME sector, and therefore are able to design tailor-made credit products to serve the SME sector. So that's a very important source of capital for SMEs. Then you can look at government schemes, where government provide various funding schemes and that are targeted at particular businesses, sometimes in certain segments of the economy, and all of this are usually linked to a bigger strategic objective that the government wants to achieve, whether it is injecting growth in a particular sector of the economy, whether it is to help a particular segment of the market, whether it's youth, in business, women in business. All these things are properly defined when it comes to government schemes. Sometimes governments work with private sector to provide guarantees. That's how they facilitate for private sector to provide funding to SMEs. So in that instance, they are not providing the funding themselves, as you'd see with government schemes, government funding schemes, but they are rather guaranteeing for private sector to provide that funding support. Then there are a set of equity capital providers. When we say equity capital providers, these are capital providers that want to provide capital in exchange for ownership interest in your business. It's very important to differentiate that from debt capital providers. Debt capital providers are your banks and microfinance institutions that want to give you a loan for you to repay back at a certain interest cost to you. But equity providers, they want to provide capital to you in exchange for ownership interest in your business. And there are three types that we can talk about. We have private equity firms. These are very organized firms that raise funds from wealthy individuals and corporates for purposes of investing equity in other businesses. Okay, and that is their modus operandi. Typically, they target very well established businesses with established track record. They like to deal with that end of the market. Then you have venture capitalists who are also providers of equity capital, but they like to deal with startups and businesses or small businesses at very early stages of their maturity curve. Okay, so typically for those type of businesses, they don't have significant history for you to rely on. So the scrutiny then will be more on their business plans. You have a business plan as a startup, and so that will be scrutinized a bit more because there's no history to look at. That's the modus operandi of venture capitalists, right? They focus on that segment of the market. Then you have strategics. When we say strategics, they are companies or businesses just like your business. For purpose of our listeners, our target market is SMEs, but of course other business types as well.
Right.
So these are other companies that may do the same things with you or not, or they may be in the same value chain with you or not. So they are either investing for purposes of profit or for other strategic reasons. It could be that they want to consolidate market shares. So since you do the same thing with them, they would like to acquire you to consolidate and increase that market share. It could be that you are in that value chain with them, so you could be a supplier to them or a distributor of their product. In order for them to have a bit more control, they would like to invest, provide capital, so they can have a bit more control, over their supply chain and their route to market in this instance. So those are what we call strategics, other businesses that can also provide equity capital, into other businesses. Then we've got what we call crowdfunding. Crowdfunding, typically, I see it's not very common in this market, but in other markets where it's prevalent,
Right.
There's a platform which is normally internet-based, where you go and list your business ideas and projects, and you are open to, or you have access to, a large number of people that are also accessing the platform. Okay, and in that instance, these are not wealthy individuals, but because of the sheer number of people, you are able to achieve your objective, your capital objective, through like what you say, little drops of water makes a mighty ocean, to put
Right.
it literally. Yeah. That's crowdfunding. Then we've got the banks, the traditional banks as we know it. The difference between them and the microfinance institutions is that they typically deal with large corporates, but these days it's not unusual for you to have a desk in a bank that is trying to, generate value from segments of the SME market. So it could be integrated in there. And then of course you have grants. Grants, like some people say, free money, but I see that free is in quotation marks. It's not exactly free because there's a very rigorous process that you usually have to go through to access grants. Okay, and that means you'd have to invest in that process. So you incur some costs at the back end in order for you to meet the criteria to access grants. So let's say that context. These are all options available for capital, for accessing capital, by SMEs. Okay, it's important we do that. Now, these various options can be collapsed into three main categories. So they are either equity capital, which is seeking to acquire ownership interest in your business, or they are debt capital, which is only being given to you for you to pay back with interest, or they are grants, which I've said is quote unquote free. You are not expected to pay back. You're not expected to pay the interest. You're not expected to pay back the principal, but you're expected to meet a certain a detailed criteria in order to access it, and so you'd have to go through a very rigorous process to access grants, and that's very important for us to lay as well. Now, at this point, maybe we'd want to understand what goes into the decision making for capital providers or financiers, right? And we'll look at it from two main angles as to whether it is equity capital, that's one, or debt capital. Okay. In most parts, these two types of capital providers go through the same process or similar process. Let me say similar process, right? But at key stages of the process, they tend to look out for slightly different things, and this is in line with their investment objective. For instance, equity capital providers are very much interested in investing equity, investing in your business, and seeing to it that their investment grows with the business, so that today they want to invest 200,000 in your business, and they are interested in ensuring that in 5 years time that 200,000 multiplies to 600,000, and at that point if they want to exit, they can then sell their stake at that rate, and then we show that over the 5 years they've actually multiplied their investment by 3 times, right? But debt capital provider, they are not interested so much in the growth of your business, right? I mean, in part they can say yes, we are helping you to grow, but their key interest has to do with
giving you the money,
yes, and the cash flows that you generate, right? They are very much interested in the cash flows that even more so than your profits. Because for them, if I give you the money and I'm expecting you to pay over 5-10 years, I need to, be convinced that over the next 5-10 years, you'll be able to generate, adequate cash flows to pay me. Even if you run into challenges and you are unable to generate the profits that you think or you envisage you will, they want to be assured that you'll be able to generate the cash flows, adequate cash flows to pay them. They wouldn't take, the kind of risks that equity providers will take, which is to own a piece of the cake. And when you're owning a piece of the cake, it comes with the inherent risk and opportunities. Okay, so in most parts, they follow the same process, which I'll divide into 2 main phases, right? But they would have, they would have about 6 stages. In the first phase, the stages would include a review, preliminary review, initial review of documentation or records of your business. It's very important. At that initial review stage, the review is mainly high level. That high level review is only to help them form their initial impression of the business. So what kind of business model are you running? What are the strategies that you are adopting? Where are you taking the business? Where have you brought the business over the last few years from, and where are you taking it, right? It will help them form an initial view of whether this is something they can work with. And post that, they will make you an offer. If you call it an initial offer or preliminary offer, that acceptance of that offer does not constitute a contract. the acceptance of that offer does not constitute a contract. It only is like a key that unlocks the next stage. So if you accept, then we can proceed from this stage, which is the second stage, which I've said, making you a preliminary offer. We proceed from that stage to a due diligence stage. At the due diligence stage, there will be a much more detailed review of whatever information they would have received at the initial stage.
That's the company's books?
Yes, the company's books. So at the initial stage, they may just ask for, a high-level financials, your business plan, financial model, and they will form their initial, view of it. But at the due diligence stage, now they will not only request for detailed data that supports those documents, but they'll be engaging you quite often, asking questions on how you came about, some of the assumptions, some of the numbers, to satisfy themselves that, there are no hidden risk anywhere that will come back to bite them. So at that third stage, which is the due diligence, there's a bit more detailed review compared to the, initial stage. Now, let me return to the very first stage and state a differentiator there in terms of equity capital providers and debt capital providers. At that first stage, debt capital providers will not be interested in the value of your business. They are not interested in the value of your business because they are not buying a portion of your business. They are only loaning money to you for you to pay back over a certain period of time. Good. But equity capital providers will be very much interested in your value. And at that point, if you have gone through the process, you would also understand that you should be throwing the value at them. Mm-hmm. That's, well, I need equity capital. And if I need equity capital, I must be ready to offload a portion of my business to you. So I'm offering you 10% in exchange of 200,000 cedis. If that is the case, you valued your business at 2 million. Right? So you're saying the value of your business is 2 million. If they give you 200,000, that is 10% of your business. And that is what you are putting on the table. So at that point, at that initial stage, equity capital providers will request, in addition to the things that they request, the valuation of your business. How have you valued your business? They'll try to understand the assumptions that have gone in there. And it's very important for them because at the tail end, they are seeking to buy a portion. And you need to know the price before you buy. And that's where the valuation comes in. So that's a key differentiator for that first stage.
Well, I hope I'm not jumping the gun, but I just wanted to find out, at what point do you advise an SME to open up to equity financing or debt financing? I mean, what should inform that decision?
Really, if I think of equity funding, right, not only do you benefit from the cash or the capital that you need. Mm-hmm. Equity providers are very technical people. Normally, before they invest in a sector, they would have adequate knowledge about that sector. So there are expertise that they can bring. And because they own a portion of the business, they will actually apply those expertise. They will form part of decision making and ensuring that you benefit from those expertise and they can help you, grow very well, right? So for me, at that SME stage, I'll say that if you are seeking to go to the next stage, you should focus a bit more on equity capital, right? Loans in particular, I'll say are more suitable to large corporates. They have over time developed the muscle. Sometimes they have stable market shares. They are very dominant in the market and they easily generate the cash flows they need because cash flow is very important in approaching debt capital, right? Mm-hmm. So I would advise that at very early stages, you do not absorb so much debt. You rather look at partnership that can help you grow. And in this case, you should look at, equity capital more.
No, so it's not the case that maybe one has much more advantage over the other?
Not really. I think it relates more to the business itself. That's the investing company, the situation of the. So if a large corporate that can easily run a project and generate adequate cash flows, you probably won't think you need another partner per se, right? And also the risk with debt capital is that you have to commit to repay. It's not a function of whether your business is making profit or not. You sign an agreement, and so you have to commit to pay. And you are probably going to have to put in assets to secure the loan. So assets that belongs to the business, you would have to put in there as collateral, and they are locked up in there. And you may not be able to access additional funding if you need it because you've locked up those assets. Okay, right. And so it can be very, very, difficult for SMEs, especially businesses that are small and at the very early stages of the maturity curve, right? I
All right.
would say that debt capital is for businesses that are very well established, and cash flows are not an issue for them.
All right, so we continue from there.
Yes, good. So I talked about the first phase of the process, which is from initial review of documentation, which is high level at that point. At which point I've stated that the differentiator there is that the equity capital provider would request for valuation of your business and any documents that support that value. Then they will make you an initial offer. Both types of capital providers will make you an initial offer based on the preliminary review. Then your acceptance of that offer will usher you into the next stage, which is the due diligence stage, which entails a far more detailed review of your financial records and documentation, right? At that stage too, the differentiator really is that the equity capital providers will do a far more detailed work on your company compared to debt capital providers. But debt capital providers are largely focused on cash flows. This business idea, this proposal, this project, is it likely to generate the cash flows that we need? Okay, so to the extent that they are satisfied after looking at certain documents, they can go ahead and go to the next stage. But for equity capital provider, because their interest is to own a portion of the business, and when they do that, they're actually owning all the risks and opportunities that it comes with. They would want to lay bare all the aspects of the business. Mm-hmm. And it can run from them commissioning financial due diligence, which is to look at your financials. They will look at tax reviews. They can look at legal reviews. They can look at commercial due diligence, which is like a market assessment to test the assumptions in your business plan. You can be in an industry that has been hard hit by COVID. Right. And then the industry is actually contracting or growing by, let's say, 2%, and yet your business plan is saying that whilst being in that industry, you will grow by 50% every year. Of course, it's not impossible. It can be that you have a very unique business model that can help you achieve that, but the point is that will be questioned and it will be scrutinized.
And this is where your credit history matters, right? Because I started the show by asking what makes a good credit history.
Yes, of course. Over there too, it's as part of the reviews, the debt capital providers will look at your credit history because they want to be interested. They are interested in ensuring whether you have the credibility to carry on with such a. So if you've taken loans in the past and you've paid them smoothly, no issues, then of course they are ready to play ball with you. But if they check your credit history and all the 3 loans that you picked in time past ended up in the court before you paid, and you are probably battling another one, currently, then of course it's a major red flag for them. They may stop the process at that point, or probably include very stringent conditions to ensure that they do not fall prey to that kind of situation.
All right.
So that's how it goes. So at that stage, the equity capital providers, I was saying, will do far more detailed work because they want to lay bare all aspects of your business and make sure that there's no significant risk that passes them by, because once they pay to own. They are not guaranteed profits because all the profits projected are expectations, and that's what they are taking their decision on. They can get in there and there will be no profits year after year. There's nothing they can do. You own a part of the business. You only get profit when profit is generated and when the board decides that profit should be repatriated to shareholders. And that's why they take their time to do detailed work before they jump, right? So that's the first phase. And the similarities and the differentiators, across that phase. The second phase is where let me take it one after the other. For the debt capital providers, once they've completed their detailed review, which is the due diligence review, the next thing that is important for them is security or guarantees. What guarantees can they put in place to ensure that they recover their money? So at that stage, they'll be discussing collateral. What assets do you have available to secure the loan? Is it cash? Is it non-cash? They'll be very happy if the security or the collateral you have is cash, because cash, it means that they register their interest in there. Once something happens, it's very liquid already. They can just resort to it. But they can also consider non-cash like properties. For that, they'll look at whether there's market for that kind of asset that they can easily trade to recover their money. Should you renege on your obligation, right? They'll look at the value of that property or collateral and ask themselves whether the value today will be enough to cover the exposure that they are putting themselves through, right? In terms of the money that they are giving you. Okay. So that's on the debt capital providers. They at that point they are very interested in the security that you bring on board, and sometimes they can ask for corporate guarantees, right? Corporate guarantees, typically you have a sister company or a parent company that's large enough, that have the credibility, that can then guarantee for you that give them the loan. Should they renege on the obligation, I'll take the liability. That's a corporate guarantee. And sometimes they can look at, where some of these things are not available, they'll put stringent conditions in the final offer that they'll give you, including maybe an option for you to open a receivables account with them, where all your credit customers will pay, towards your receivables in that account, so that they have control over it. So they are very much interested in the security of the facility at that point in time. Once they go past that stage, then they can make you the final offer. They make you the final offer. If you are happy with the terms and conditions, you sign. Normally there will be conditions precedent, so you go ahead and meet all the conditions precedent, and then the funds will be released for you.
Okay.
That's typical for debt capital providers in that second phase. For the equity capital providers in that second phase, after the due diligence, they are likely to make you a binding offer immediately after the due diligence process. Okay. Remember, the offer they made to you in that second stage was non-binding. It was only for you to accept, so they can continue the process. So in this second phase, that first stage, in that second phase, they make you a binding offer. At that point, they feel they have enough information to make a binding offer. So they will inculcate all the risk that they would have identified and valued, and they would have reflected same on the value of your business. So that offer will indicate that, well, you wanted, for instance, as an example, you wanted 200,000 for 10% of your business. We will give you that 200,000, but for 5% of your business, because we think that your business is worth 1 million, not 2 million, as you initially, proposed. And that will be because they've identified some risks that they would have valued and reflected or adjusted on the valuation that you brought to them. And that typically would usher into a negotiation and deal structuring phase, because you are not likely to be smiling to every term in that binding offer.
Right.
For instance, your value has been slashed by half, so you are going to have to go to the negotiation table. And typically at that stage, if the two parties are willing to do a deal, then they are going to come to some sort of compromise, and then they end up signing a deal.
You talked about terms and conditions. I just, by way of education, what are some of the terms and conditions you expect? I'm asking because maybe under equity funding, the investor doesn't get value for the money invested in the company. What are some of the conditions attached to these agreements?
Okay, so at the foremost, like I said, they will state that they are ready to give you the money you want for a certain percentage of the business. There are certain conditions that they will put in that agreement. For instance, the fact that they want a board representation so that they can take part in, decision making, at the very apex of that decision making structure. Okay. That's one thing they will request, equity capital providers would request for. They may also see certain things that at the time of the review are unable to value. They know that these things are a risk, but they are unable to estimate its impact on the value of your business. So, or some of them could be things that could crystallize post signing of the agreement, right? It looks like there's a risk. Like, let's say you are in court, somebody has taken you to court. We don't know what the end will be, but it's been estimated that should you lose, you are going to have to pay 5 million cedis, right? They are going to include conditions in that agreement to say that, well, we are not certain as to whether this is going to happen, but should it happen after we have signed the agreement, it's going to be your liability.
Okay, Dennis Brown is my guest this afternoon on the Masterclass. We are discussing what lenders and investors want to know. The Masterclass live on Joy 99.7 FM. We're also streaming live on our Facebook platform, that is Joy 99.7 FM. We are going to take a short break. When we come back, we're going to open the phone lines for you to ask your questions, as well as make contributions if you have any. The lines will be 0302216541, 0302216541 for calls, and if you want to send a message, 055 1111997, 055 1111997. We've got more after this break. Stay with us.
Your favorite on-air business development program, Joy Business Masterclass, is in session, and you can interact with us on Facebook via the Joy 99.7 FM or Joy Business pages. If you tweet, the handle is at Joy 997 FM or at Joy Business GH. Don't forget to hashtag JB Masterclass. You can also call us on 0302 216541 or send your questions and contributions through to the WhatsApp number 0551 111997, and our facilitators will address your concerns. Attention everyone, class is in progress.
All right, welcome back to the Masterclass on Joy 99.7 FM. The Masterclass is brought to you by Gwel Energy, Gwel Yanara India, and GCB Bank, your bank for life. Gwel has good news for you. Gwel is rewarding its prepaying Gold Card customers with 2 pesos discount per liter on fuels. You also can enjoy discount on lubricants at Gwel stations nationwide. Elevate your goodness by joining Gwel Go Club today and enjoy up to 3 pesos per liter discount on fuel, amazing discount on lubricant purchases, free life insurance cover provided by My Life Insurance, accrue and contribute loyalty points to a social group to fund unapproved CSR projects, and above all, enjoy exclusive Gwel branded campaign gifts. Join the Go Club by visiting Gwel stations or offices, Gwel website, registration.gwel.com.gh, and all Gwel social media platforms. Individuals, corporate, family, and social groups join the Go Club now. Gwel Good Energy, Gwel Yanara India. In studio with me is Dennis Brown, who is Senior Manager at Deloitte Ghana. We are discussing what lenders and investors want to know. And in these days of economic squeeze, I mean, people don't give out money anyhow. And so they are interested in what you're doing with your business. We've talked about grants. We've talked about equity funding as well as debt funding. We're in the middle of that discussion before we went on the break. But you can join us with your questions as well. If you run a business, you're looking for investors, I'm sure there are some questions on your mind. You can join us on phone. It's 0302216541, 0302216541, or send us a message on WhatsApp, 055 1111997, 055 1111997. And so we'll await that. But meantime, back to our discussion with Dennis Brown. And so, yeah, we're talking about terms and conditions and all of that. I also wanted to find out my question during these times, as I indicated, is really difficult for people to just give their monies to any business because of obviously the situation we are facing with the economy. So, question is there money out there for people to invest in businesses?
Yeah, I'll say that there's money out there to the extent that there are people that are into the business of providing capital. There is money out there. The difference is that in and around this time, your business plan and business model will really be tested, right? It's a post-COVID recovery thing. Everybody's going through it. It's been very challenging. The economy appears to be, suffering as well. So providers of capital will be very much interested in seeing that all these things have been factored into your business plan, and that what you have in there is not a set of fanciful ideas, because everyone is going through, and so everyone is aware that businesses, going forward, are going to have to feel the crunch a bit. So if we look at your business plan and you seem to be on an island on your own in a very nice place, expecting that you'll be doubling revenue every year, that obviously will be questioned and will be scrutinized, and chances are investors will not take you serious if you haven't taken time to take these conditions into account. You haven't taken time to factor them into your business plan. That is what will make it difficult for you to access capital. But capital is there. Private equity firms are still raising funds, and some of them are sitting on large funds. Except that before they invest, before they jump, they will look, and listen, and probably even fail as well, before they do that. So the scrutiny will be far more around this time.
And the other thing I also wanted to ask under equity funding is the fear by most businesses or some small businesses that the company will be taken over by the investor because they have maybe representation on the board. Is that something to be concerned about?
I don't think that's something to be concerned about, because up until you decide to go for equity capital, you would have the control of your business, and you can then decide how you want to structure the deal. So you can allow for, let's say, significant minority to come in, right, and still own, let's say, 51% if the whole objective for you is to retain control of your business. Now, I talked about private equity firms, and I did indicate that these are firms with people that have expertise that can help, if you partner them, can help you grow, right? They don't seek to be in your business forever. They don't seek to be in your business forever. Typically, they look at a time frame of between, let's say, 5 to 7 years, right? But the sort of value they bring to you, including the expertise they bring on board, can help you grow. And at the point where they are exiting, you would have achieved substantial growth. If you have the capital or the financial muscle, you can buy them out because they are seeking to exit anyway. So you can look at that angle. If your issue is your business, somebody will take over your business, then you can look at private equity, even if they come in with a majority, and some of them have their investment objectives, some of them want to do significant minority, except that you give them representation on the board, of course, because they own part of your business. But the most important is that they will help you along the journey to grow, because it's also in their interest to grow their investment. And so at the point where you are exiting, you would have grown substantially, and you can organize to buy them out. If your issue is that you have a bit less control than you expect.
And usually with these kinds of arrangements, is there duration to it? Let's say, well, you're coming to invest in this company over a period of these years, and after which we have to revise whatever agreement that we have.
Yes, all of that can be sorted out in the sort of contracts that you sign. Right, so you can sign an equity deal, all right, but you can include in there that after 3 years, I mean, there are all sorts of forms of that in which that deal can come. Somebody can say, I'm giving you 200,000 for 10% over a period of 4 years. If I'm able to recover my investment, right, through the profits that you repatriate to me as an equity holder, I'll drop to 10%. It can be indicated, and you can sign onto it. At the point of signing the contract, you have control. So you can determine which term you like or which term you don't like. If it's too stringent for you, then maybe that partner is not for you. And so you can look elsewhere, you can consider other options. So all those things can be taken care of with the kind of contract that you sign in terms of equity capital. And again, in terms of equity capital, I mentioned private equity firms that they don't seek to be there forever. So they seek to be in there for a set period, typically between 5 to 7 years. And their objective is to grow their capital. So they are not so interested in, regular repatriation of profits to them. They would rather have the profits re-injected back into the business to, continue growing, to inject growth, so that at the time that they are exiting, they will normally have an investment objective. My objective would be that if I invest today, when I'm exiting, I should exit at 4 times. Which means that if I put 25,000 in the business today, in 4, 5, 7 years, when I'm exiting, I should be able to exit at 100,000. Okay, that's what they like to do. So they don't want to stay in there for forever. So that's also an option.
Anything else we need to know?
Yes, at this one, I think we need to quickly look. We mentioned that at the due diligence, when we are talking about the process, we mentioned that at the due diligence stage, that's where a bit more detailed work is done by both the equity capital providers and the debt capital providers. So at this point, it's important we look closely at what the key considerations are for them at that stage, because that stage is probably the most important for the contract. It's the most important in the entire process.
Right.
Because it's post the due diligence stage that they are then going to make you a final offer which is binding or not. At that point, they can decide they are not doing it.
Okay, let me just interrupt you and just read a few of the messages that have come through. This one says, "Hello, Daryl. Great show for an investor who is looking to place some funds." Just give me a few seconds to. Okay, let's skip that. Let's go to this one. "Hello, Daryl. How can one identify or find an equity investor?" That's a message coming from Nana. Let's do the other messages. This one says, "Great presentation, very insightful. I've learned a lot this afternoon." Duke from SNIT. Let's read one more message. The one I couldn't do. That is, "Hello, Daryl. Great show for an investor who is looking to place some funds. Which option will carry less risk, debt-based funding or equity-based funding?" And that message coming from Winston, who says he likes your submission as well.
Okay. So on that question you just asked, which one carries less risk? The one that carries less risk is debt capital, right? Because the nature of it is that when you invest, ordinarily you are assured that you get your money. Okay, that's the nature of the contract. That it's not a function of whether the business is doing well or not. So whether the business is doing well or not, there's a signed contract that says that at these regular intervals you have to pay me this amount. Failing which you can take them on. So that's more assured, and that's why it carries less risk. Okay, but if you invest in equity, that means that you are investing to own a part of the business, and so if the business is not making profits, you bear the risk, like you own it. So that's riskier, if you ask me. But it's a risk and reward thing.
All right.
It's riskier, but it will turn up to be more rewarding.
How could one identify or find equity investor?
So I talked about the various types of equity investors. In fact, I mentioned the third one, which is strategic investor, which are other businesses seeking to invest equity, right? Those ones, every company then is a potential strategic investor. But beyond them, you have the venture capitalists and the private equity firms, right? With a simple internet search, you'll be able to find the private equity firms that are operating in Ghana and the venture capitalist firms that are also operating in Ghana, and you can approach them. So that should be fine.
Well, I'm not too sure if we can take any more messages. 0551111997, or this other message, just coming through, says, "Hi, my name is Ken. Is there any agency that can help small businesses package themselves to seek for funding, equity or debt?"
I think, as to whether there's a name that can be mentioned, I'm not so sure. But I think if you approach venture capitalists, right, and explain your ideas to them, they probably put you through, or let you in on some of the things that they are interested in, because the kind of business she's talking about, it's basically like a starter or a small business, which is what venture capitalists are interested in. So if you approach them, they'll probably tell you the kind of things they are interested in, and that would also help you package your business. But honestly, I don't know of a name that is an agency that's designed to help small businesses package themselves for capital.
Okay, I just feel that you have a lot to share. We've just scratched the surface of it, but we've run out of time actually, and so maybe there should be a part 2. Maybe the producers would have to consider that. But that's been the masterclass for you. You want to say something? Just 30 seconds, because I really have to rush out of the studio.
Okay, the 30 seconds is not enough to cover the rest of the material. But I think at this point, I want to throw in this advice to SMEs. Typically, what we find is that they typically don't pay attention to keeping good records, and that can affect them in that process to obtain capital. Because as I've mentioned, that is very, very important.
Do you mind sharing your contact, because somebody wants to have a contact, maybe?
Okay, that's fine. Can I?
Yeah, just go ahead.
Okay, 0243 20 58 00.
0243 20 58 00. If you have some more questions, you can bother Dennis Brown. He's senior manager at Deloitte Ghana. I'm sure he'll have some good advice for you. I see some of your questions still coming through, but we need to...
Don't call late in the evening.
Somebody's calling your phone right now. But that's the masterclass, everyone. Thanks for listening. You can always... head back to Facebook and listen again and again at this presentation by Dennis Brown, who's senior manager at Deloitte Ghana. Remember that the masterclass is brought to you by Gwell Energy Gwell, Yanara and GCB, your bank for life. I don't know if there'll be a part 2, but watch out. This is certainly something to revisit. Thanks for listening, everyone. Ignition continues right now. My name is Daryl Kwawu. Goodbye.